Hello, in this video, I will teach you about the 4 main different stock order types used in trading, so stick around till the end of the video to understand. Due to many online stock trading platforms like TD Ameritrade, Fidelity, E-Trade, just to mention but a few, many investors around the world are choosing to buy and sell stocks online instead of paying large commissions to advisors to execute the trades. However, before you begin buying and selling stocks, you must first understand the various types of orders and when they are appropriate. So an order is simply a transaction meant to be executed at a specific market price. There are several stock market orders, but in this video, we will learn about the 4 common stock orders, and these are the market order, the limit order, the stop loss, and the stop limit. So the market order is the most fundamental, or rather the basic type of trade. It's simply an instruction by an investor to a broker to buy or sell stock or shares at the best available price in the current financial market. If you are going to buy a stock, you will usually pay a price that is close to or equal to the posted ask. If you sell a stock, you will receive a price that is equal to or close to the posted bid. One thing to keep in mind is that the last traded price is not always the price at which the market order will be executed. In volatile and fast-moving markets, the price at which you execute or fill the trade may differ from the last traded price. Only when the bid or ask price is exactly at the last traded price will the price remain constant. So the important part to note about this order is that market orders do not guarantee a price, but they do guarantee the order's immediate execution. Let's take an example on this chart. The market is moving up and down. The moment you press your button to sell, and in this case you can see we are lucky enough to sell this stock at exactly $40 mark price. This will now be our market order price because it's instantly executed at the press of a button. The advantages of using a market order is that it's usually the lowest price option, because some brokers tend to charge more in transaction fees that involve limit orders. Because large cap stocks, which are simply stocks of a company with a market capitalization value of more than $10 billion, they are highly liquid, so a market order is a safe option. Large number of these company shares are traded at any given time during a trading day, so the transactions are completed immediately. Unless the market is extremely volatile at that time, the price displayed when you click buy or sell will be nearly identical to the price you receive. The downside of the market order is that it's less reliable when trading less liquid investments, such as small cap stocks or troubled companies. Because of these stocks being thinly traded, the bid or ask spreads tend to be wide. As a result, market orders can be filled slowly and at a very disappointing price. So let's check on this second type of order, which is a limit order. This is a type of order to purchase or sell a security at a specified price or better. For buy limit orders, the order will be executed only at the limit price or a lower one, while for sell limit orders, the order will be executed only at a limit price or a higher one. This stipulation allows traders to better control the prices they trade. The investor is guaranteed to pay that price or less by using a buy limit order. While the price is guaranteed, the order is not guaranteed to be filled, and limit orders will not be executed unless the security price meets the order qualifications. If the asset fails to reach the specified price, the order is not filled and the investor may lose the trading opportunity. A limit order gives a trader more control over the execution price of a security, which is useful if they are hesitant to use a market order during periods of high volatility. A limit order can also be useful if a trader is not watching a stock and has a specific price in mind at which they will be willing to buy or sell that stock. Limit orders with an expiration date can also be left open. Let's take an example on this chart. The market is going up and currently is trading at $40. We want to buy the stock at $30, so we put our limit order there because that's the maximum amount we are willing to pay. When the market touches the $30 mark price, that's when our trade will be executed. So let's check on a sell limit order. This is simply the opposite of a buy limit order, and in this case, we are putting the minimum price we are willing to sell a given stock. Let's take an example on this chart whereby we can see the market moving down and it's now trading at $20. We target to sell the stock at $30, So we put our sell limit order there because that's the minimum amount we're willing to pay or even lower. When the market touches the $30 mark price, that's when our trade will be executed. So the key points to note with limit orders is that your trade isn't guaranteed to fill completely, and secondly, your trade can fill in several parts. This can be noted when you open your account and you find several trades executed whether on buy or sell positions. The other stock market order that we'll discuss is the stop loss order. This type of order is essentially an automatic trade given to a broker by an investor to trigger a sale when a certain price level is reached to the downside. Once the price of the stock in question falls to the specified stop price, the trade, either a market or limit order, executes. Such orders are intended to limit a trader's loss on a position. Let's take an example when you are uncertain about the market movements because you can't be sure if it will be an uptrend, downtrend, or sideways. You wait for the stock to go to a specific price so that you can buy it. Like in the chart below, when the stock starts trending up, you can put your buy stop at $30 mark price. So once it hits $30 with the uptrend, then it will become a market order. The buy stop is used in the strategies described above to protect against bullish movement in a stock. Another less well-known strategy employs the buy stop to profit from anticipated uptrend in stock price. The next will be sell stop loss order, which is mainly used to prevent yourself from losing money if the security or stock price drops, hence the name stop loss. The first way to use the sell stop loss order is, for example, on this chart, we can see the market moving in an uptrend. We can buy the stock price at $20 and we wait for price to move and set our sell stop loss order at $10. When the market started to go down like we can observe, our sell stop loss will be executed, making us to lose $10, which is less compared to if we didn't have a sell stop loss order. The second way to use a stop loss is to maximize on the amount of profit we can get in a trade. Let's take an example on the chart below. We can buy this stock at $20. The market starts to move more higher, but we are not sure whether the uptrend will continue. So we put our stop loss just below the recent lower price point so that even if the market will come down, we will not give back all our profits that we had just accumulated. The last order that we'll discuss about is a stop limit order. This is a conditional trade over a specified time frame that combines the characteristics of a stop order with those of a limit order and is used to reduce risk. It's simply a combination of a stop loss and a limit order. So with this type of order, you wait for the price to go up, and once it hits a specific target price, it will trigger a limit order to buy once the security price starts to drop again. Let's check on two scenarios, and the first one will be a buy stop limit. On our chart, we can observe the market price is starting at $10. So we will not buy immediately because we are not sure if the market will continue going up or not. We put a stop price at $30 because when it hits $30, that's when we can confirm an uptrend will continue. So we don't actually want to pay the $30 for it. We put our limit price at $25, which is a more better price, so when the market comes to the $25 mark, our trade is executed. The second scenario is the sell stop limit. When the price drops down to a point you have just set as your stop in the market, it will trigger a sale at the minimum price you entered as a limit. Like on the chart below, we can see the stock market price is starting at $60. So we will not sell immediately because we are not sure if the market will continue going down or not. We put a stop price at $40 because when it hits $40, that's when we can confirm the downtrend will continue. So we don't actually want to sell for $40. We put our limit price at around $30, which is a more better price to sell when the market comes to the $30 mark price. Our trade is executed. A time frame for when the stop limit order is considered executable must also be specified. The primary advantage of a stop limit order is that the trader has complete control over when the order is filled. The disadvantage, as with all limit orders, is that the trade is not guaranteed to be executed if the stock does not reach the stop price during the specified time period. Watch my next video on 1-minute scalping trading strategy with the zigzag indicator that top traders use to get more profitable in your trading journey. If this video has been helpful, remember to like, share, and subscribe to the channel for more future content like this. Till next time, see you.